Hello, everyone. Well, the dollar gained further Wednesday. This continues the pattern we've seen in recent months of how the even disappointing figures for the non-farm payrolls don't have any lasting effect on the dollar. So yesterday, a much better than expected result from the Empire State Manufacturing Survey and some acceleration in U.S. producer prices sent U.S. bond yields and the implied interest rate on the Fed funds futures up further. The Beige Book, too, had some positive things to say. And these rising yields are once again supporting the dollar, and yet they're not hurting the stock market. The S&P finally managed to close just barely in positive territory for 2014. Now, I expect the dollar to continue to firm into the FOMC meeting later this month. Even Chicago Fed President Evans, who's a noted dove, said yesterday that, quote, "it makes a lot of sense," unquote, for the Fed to reduce its monthly bond purchases. But the market seems to be still discounting the possibility that the Fed delays tapering. The 10-year Treasury yields are still below where they were before the payroll figure, as are the implied yields on the long-dated Fed funds futures. So the market still has further to go to get back to where it was before that figure. And therefore, the dollar can still rally further, I think. Now, the outlier yesterday was the Canadian dollar, which strengthened on reports that the Bank of Canada is less willing to cut rates as the Canadian dollar weakens. Reuters poll out yesterday, though, said that analysts think the Bank of Canada's next move on rates will be a hike, not a cut, but that it won't come until the second quarter of 2015. However, if you look at the rates in the market itself is still pricing in a greater chance for a cut in rates by later this year. So that makes me think that there's room for analysts to change their minds and revise down their forecasts. That would weaken the Canadian dollar. Also yesterday, the surge in oil prices following the plunge in U.S. oil inventories in the most recent week may also have helped the Canadian dollar. But personally, I remain bearish on oil prices, so I think that'll be a negative factor for the Canadian dollar too. Today, we're waiting for the Eurozone final CPI for December. A downward revision, although unlikely, would attract some concern in the Eurozone and would probably send Eurodollar lower. The U.S. CPI, on the other hand, is estimated to have accelerated on a month-on-month basis. Weekly jobless claims are expected to be stable, the Philly Fed survey is forecast to rise, and the U.S. National Association of Home Builders Housing Market Index is estimated to remain unchanged at its highest level since 2005. All told, this kind of data should be dollar supportive, and I'd expect the dollar to rally on the news. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.